Hi, everyone. Welcome to the official ESOP Radio. Thanks for joining episode 4 of the ESOP Boot Camp, the ESOP tax advantage everyone talks about explained simply. We're going to talk about ESOP tax benefits today. Our goal with the boot camp is to give you, the owner, CEO, or CFO of a successful business, the lowdown on ESOPs in a quick, straightforward manner because your time is valuable. We disclaim that we are not providing investment advice. I'm Trevor Gilmore, CEO of Menke.
And I'm Ben Spadt, Investment Banking with Menke. Since 1974, Menke has been a full-service ESOP advisor. We've seen it all from capital raise to structure to regulatory compliance, value, and M&A. We've done thousands of ESOPs over the last 51 years. And as an ESOP ourselves, we're ESOP native. And today we're going to cover the 3 tax benefits that are available to ESOPs. Number 1, a Section 1042 rollover. It's the first decision to make and it drives everything. Number 2, ESOP tax deductions, whether you're a C Corp or an S Corp and the difference between the two. And number 3, how ESOPs can eliminate the federal income tax for the corporation. All right, Trevor, let's kick things off. Head us off with 1042.
Thanks, Ben. So big picture, what is 1042? It's a part of the tax code, and it's very similar to a 1031 exchange. So for you people out there who have had real estate investments and have gone through a 1031, the 1042 spirit is very similar, except it applies to owners of C corporations who sell their stock to an ESOP. So that's one key requirement. You have to be a shareholder of a C corporation and sell that stock directly to the ESOP. And also in that transaction, you need to sell an aggregate of 30% of the shares. And more on the exact requirements later. We could talk about the 1042, for like 2 hours, right? And this is supposed to be a high level overview here. So let's get into it. So big picture, 1042, like a 1031. Okay, and I'll give an example here. So I sell a business to the ESOP. I'm a C Corp shareholder, and let's say I sell all my stock to the ESOP for $50 million. Okay, now I want to elect 1042, and what do I need to do? I need to buy $50 million worth of QRP. What is QRP? That's qualified replacement property. Basically, QRP is U.S. stocks and bonds of active operating businesses. Also, some private C corporations apply as well. Generally, real estate is excluded because it is not considered active. So with that, okay, what is this menu of QRP options out there? The overall 1042 market, by and large, is dominated by a lot of U.S., like large U.S. banks here. So think the big ones you see on the news, JP Morgan, Morgan Stanley, RBC, UBS, Deutsche Bank, Wells Fargo, B of A, and so on. And one of the common strategies out there is what is called a floating rate note. And what is that? It's basically issued by a corporation and long dated, because if you're buying this QRP, and by the way, you can't sell your QRP and buy a new QRP and still defer the tax. If you sell QRP, you pay the capital gains related to that piece. So it does allow you some tax timing here. But let's get back to the example. So FRNs are out there, long dated. If you're doing this strategy, and let's say you want to hold this QRP until it becomes part of your estate, your heirs get a step up in basis. So, it could be a valuable long-term legacy and estate play, right? When you think of generational wealth and so on. But FRNs is one strategy, and more on that later. Another strategy is equities, right? Or a combination of the two. Usually what you're going to see overall is the form of some leverage to acquire the full QRP portfolio. And the reason being is that in this example, I sold $50 million worth of stock to the ESOP, but I don't have $50 million of cash, and you have 12 months from close to get this QRP. So how do I achieve $50 million of QRP when maybe I got upfront cash of maybe 10, 15, maybe 20 million? And the answer is leverage. So nearly all of these QRP strategies out there involve leverage, meaning I'm going to put up maybe 10, 15, 20%. In this case, let's just say it's 20%. So 20% of 50 million there is 10 million. So I put up 10 million of cash to buy 50 million worth of QRP. And then a financial advisor who sells these products is then going to show you what does that long-term strategy look like in terms of if it's FRNs, the interest income, and then you're of course going to have some leverage expense, right? Or if you go equities, same thing. FRNs, usually can be leveraged up there. We see that out there. There's some equity strategies as well. Alpha Architect, some other players that are in that space, and they have solutions out there too, involving more equity, so for people that are looking for more of an equity style return. And again, when you think about this, the math is, okay, for one, tax deferral, right, can be powerful, but you also need to compare opportunity costs, right, and so on, and look at the long term. And it's very much an individual decision if the 1042 makes sense. So working with your wealth advisor, your overall long-term trust and estate planning, and so on to make that a proper decision. We cover in our ESOP fit analysis, we do a bit of a deep dive here too to show you, hey, these are what possible outcomes look like. The alternative to not going down the 1042 path is having a taxable sale. And what does that mean? It means I'm going to pay capital gains, probably on the installment basis, because if I'm carrying a seller note, plus maybe some bank financing, more on that later. We have next episode is all about how you finance an ESOP, but that's the alternative, is paying capital gains versus deferring. So key takeaway here is, number one, if you're interested in selling to an ESOP, is that the 1042 is probably one of the most important decisions you're going to make heading into an ESOP. It is something you need to figure out before you go through the negotiations and so on, because a lot of things drive this. The corporate form does. If you're a S Corp now, you're going to have to convert to C Corp. If you're a C Corp now, okay, you're probably in good shape, but we need to do some research to look at your holding period and so on. And then also we need to figure out, working with your advisor, what is your QRP strategy, because that dictates how much liquidity up front you get out of this ESOP transaction. And that dictates whether you go on the big financing path, or if there's excess cash, or if you have assets on your personal balance sheet that you can use to get this portfolio. So in a nutshell, QRP options and the 1042, by and large, FRNs, equities, so on. And there's no right or wrong answer, as I pointed out there with the 1042 QRP. And I gave you the example of selling 50 million there. So yeah, we can talk about this for hours, but let's go ahead and move on here. And you can always reach out to us, LinkedIn, email, so on, to continue the discussion here. So let's go ahead, Ben, talk about the actual corporate tax benefits for both the S Corp and C Corps.
Absolutely. Those are some great points there, Trevor, on the 1042. And you're right, it can become very complex. But part of that ESOP fit analysis is showing taxable sale versus 1042. How big of an impact does it make? And then we talk about the requirements. So we try to guide you through every step on that one. But let's keep with the C Corp structure. You've sold your company $50 million. Now the company is owned 100% by the ESOP. So then what? What does this mean for everybody? Well, in a C Corp, federally you're taxed at 21%. State might tax you at another rate on top of that at the entity level, the enterprise level. So in order to reduce that, Trevor sold his company, perhaps with a seller note. We'll say he didn't go to a bank at all. So the payments that the company makes on that loan is deductible. Those interest expense would be deductible, things like that. In addition to that, because the ESOP is now set up, the company is going to make a retirement contribution to that ESOP, which is also deductible as an employee benefit. So we get a little bit of help there by reducing our taxes at the corporate level. But let's think about this in another lens where the company is 100% owned by the ESOP, the one that Trevor sold here. If we're an S Corp being a pass-through entity, would pass through those profits to the ESOP. And the ESOP is set up as a trust. It would get a K1, but the trust doesn't pay any tax because it's a retirement plan. So because of that, regardless of how much profit you're sending down to the bottom line, the ESOP never pays tax. So in a 100% ownership scenario, that means no tax. And we'll talk about that a little bit more and some of the nuances there. There will be, in other examples, like the 49% examples we talked on the last episode, or, we'll trade Trevor's company out for one that's selling a minority interest. That 49% then, that flows through those profits that would flow through to the S Corp shareholders, flows through to the ESOP. You don't pay tax on that 49%. But the other partners or the other owners do, the other S Corp owners. So if Trevor still owns 51%, he's going to owe tax at that personal rate, max rate being 37% plus your state. So the company often issues an S distribution out to the selling shareholder or the shareholders at this point. So they would send one to Trevor, but they would also have to send one to the 49% owner, which is the ESOP. And so that is not a retirement contribution, but is required as an S distribution. If you're going to give it to one, give it to all, that sort of thing. So that's another way to get some cash into the ESOP, but maybe where that S versus C question comes into play, what's more preferable? And, you'd have to have conversations with your CPA as well as your ESOP advisor to figure out what the best strategy is on a minority transaction. Seems pretty black and white on a 100%, but.
Exactly. A lot of nuance there on minority. And, we see that out there with a minority, let's say an S Corp, coming in buying, let's say 25, 30% of the stock, and then it stays there forever, never increases the ownership. So what do you see long-term is the S Corp continues to get those ESOP share of the tax distributions, but the ESOP doesn't have to pay tax, right? Because it's a tax-exempt shareholder. So you see the participants in the ESOP's account balance really grow, and you see that, and over long term, can be huge. We have some clients who have 15, 20 million in their ESOP because they're partial S Corp ESOPs, and they've had that structure in place for a long time. And the company now is kicking off 15, 20 mil EBITDA, and the ESOP is just getting this, right? So people are retiring with these very sizable cash account. And from a corporate perspective, you're like, okay, should the ESOP at some point go 100% or not, right? And that's all part of the strategy, right? It's very much, you think, what makes sense now over the next 1, 3, 5 years, and then of course long term, and there's ways to correct strategy and so on. And I think you covered very clearly the differences between C and S. Especially
I liked your point there, not to interrupt, but I really liked your point there of it depends on where you are in the life cycle of what strategy is best for you. And working with your ESOP advisor would help you. Early ESOPs are pretty much as the plan is written up, that's how it's going to operate. But 5 years down the road, that might not be the best idea, or perhaps some tweaks are needed, whether it be a window amendment, small plan amendment, or there are things you can do to your distribution policy, what have you. All conversations for another episode, but it just illustrates the importance of having an advisor with you, every step of the way, not just during the transaction, not just during, perhaps a second stage transaction, but having somebody there with you along the way.
Exactly. Yeah. And we have those conversations with clients all the time, right?
Yeah.
Especially on our ESOP sustainability side, 'cause we do these transactions, working with business owners, like everyone listening, help with the transition. And then since we do the ongoing compliance advisory, we're there. So what makes sense today might not make sense in 5, 10 years, right? And there's always levers you can pull.
That's, 100% accurate.
Taxes too, right? I know when I got my master's in tax, one of the key things was, hey, taxes can change, with every whim of Congress. So, what makes sense and what's eligible today might not be tomorrow and so on.
Yeah.
On the plus side,
Speaking of tax, I wanted to say, I alluded it to a little bit. And last episode, we had sort of the downer at the end of, when is an ESOP not a good fit? Today, we have a little bit of dessert at the end. And I think everybody would want to know, how do you not pay tax? And Trevor, you want to talk about how an ESOP can potentially be tax-free?
Yeah, exactly. And this is the end game for a lot of ESOP companies that envision themselves becoming 100% employee owned. So let's think this through here. So an S Corp is a flow through. All you S Corp shareholders out there, you get a K1 every year, and you're paying taxes, right, based on that corporation, right? You get a cash flow distribution to pay those taxes and so on, versus a C Corp, which is a taxable entity. So C Corps are not flow throughs. They pay the tax at the entity level, meaning the federal right now is 21%. We're recording this in late January 2026. So that's the Fed rate right now is 21%. And then state too. If you're in a state that has a corporate income tax, right, then the C Corp's on the hook for that. Now, I know some states as Corps, you can do the PTE, the pass through, some you can do that for state. But in any case, big picture, C Corp, taxable entity, S Corp, flow through. So the individual shareholders pay the tax. Now, what is the ESOP? ESOP is a tax exempt trust, meaning it does not pay current income tax. Participants in the ESOP are taxed when they pull money out if they don't roll over. So if they roll money over to another qualified plan, think IRA, think 401k, so on, then you're rolling over just like any other retirement plan. You're going to pay the piper when you actually take that money out at some point. But let's say, if someone retires and they, take money out of the ESOP and they just use the cash, then that's when they pay the piper. That's when they pay the tax. But the whole time the ESOP is a shareholder, it is not paying tax. So you think, okay, S Corp, 100% owned by an ESOP, then does not need to make tax distributions because the ESOP is not paying current income tax of the corporate earnings. So that is huge. So you think, 21% Fed, I'm based here in California, overall effective rate for most C Corps here is 28%. But if you're an S Corp shareholder in California, your effective rate, using round numbers, about 50%, right? So if you don't have that cash going out the door, what can it be used for? Well, for one, it's going to pay down the ESOP debt. That's huge. 2, help fund the ESOP repurchase obligation. And 3, help you, once that ESOP debt is paid down, acquire companies, grow your company, so on. And we are seeing that a lot of ESOP holdcos out there, kind of grow in that way. So it's a huge benefit, 100% S Corp ESOP. And there's many, many successful examples out there, of that. So it is a journey, right? Some people go right off the gate, 100% S Corp ESOP. Others say, hey, let's do a phased approach here, and so on. And especially with the 1042, as you talked about earlier, if you're an S and you really want to do 1042, then we have to work with your CPA, convert you over to a C Corp, then you can do the 1042, and then you generally have to be a C for a while, 5 years is, the general guidance there before you can transfer back to S. And then you also might be faced with that 5-year built-in gains as well from the C to S conversion. So it's very much a nuanced decision, right, to go back to the 1042. And one thing, and I know we're going to wrap this up here in a second, but about that 1042 discussion, how you inform the IRS that you elected 1042 is you file a statement on your tax return in the year of sale, and you also list all the securities you bought. And that's how you inform the IRS that you elected 1042. So that's one thing I think I missed in our earlier part.
Yeah. And that's the personal tax return, not the corporate tax return, correct?
Exactly. Yeah. So in that example, selling 50 million of stock to the ESOP, then on my personal tax return, I would file that 1042 and list out all the securities I bought, and so on. So that's how that works. Of course, more on that, consult with your tax advisor, of course, financial advisor, et cetera.
I mean, that's really it for episode 4. And we covered a lot, but basically 3 essential topics here. Number 1 is the 1042 that Trevor was just talking about. Number 2, the ESOP tax deductions, C versus S, what can we do? And then finally, how ESOPs can eliminate the federal income tax. And thanks for joining us today. We hope you enjoyed it. Connect with us on LinkedIn, myself, Benjamin Spadt, or Trevor Gilmore. Connect with ESOP Radio, also on LinkedIn, or just come straight to Menke.com, where we have a wealth of information, webinars, case studies, things like that, where you can learn more about becoming an ESOP if you're interested. And if so, reach out to us to learn more about this and our ESOP fit analysis, which is really the first step in assessing if an ESOP is right for you. Have a great day and join us for episode 5 next time, How to Finance Your ESOP. Thanks and goodbye.
Thanks, everyone. Take care.